Welcome, everyone. Today, we're diving into the latest financial results from Noel Gifts. Now, you probably know them for their hampers, but the headline numbers just dropped, and they are hiding a much bigger and, honestly, a much more surprising story.
And to help us unpack it all, I've got Ben, our analyst, here with me.
Hey, Alex.
So Ben, everyone sees Noel as the gift company, right? But from an investor's perspective, the real story here isn't what's in the gift basket. It's what's on the balance sheet. And that's where things get really interesting.
All right, let's kick things off with the number that really jumps off the page. A massive 37% surge in revenue compared to the same period last year. Ben, that is a fantastic number. What is going on here?
It really is. And the financials are crystal clear on this. This isn't some one-off deal or an asset sale. The entire $7.97 million in revenue came straight from their core business, selling gifts and hampers. It tells us their main operation is absolutely firing on all cylinders. Demand is just incredibly strong.
Okay, and that's not the only piece of good news. They've also managed to slash their net loss by over 95%. They went from losing over $1 million to a loss of just $51,000. I mean, they are right on the doorstep of being profitable, which, of course, brings up the big question.
How is it possible that with revenue growing by more than a third, they're still not making a profit? You'd expect them to be well in the black, right? So what gives? Then walk us through the profit puzzle.
Right, so the answer's right here in the income statement. It's a classic case of one number growing faster than another. So look here, while revenue shot up by 37%, the line right below it, cost of sales, that's the direct cost of the flowers, baskets, everything, it grew even faster at over 42%. So their gross profit just couldn't keep pace.
You know, it's a perfect example of what we call margin compression. The best way to think about it is like this. Imagine you run a cafe and you're selling more coffee than ever before. That's great. But the price you're paying for your coffee beans has shot up so much, they're actually making less profit on every single cup you sell. That's pretty much what happened here. But here's the interesting part. While the cost of their products went up, they showed some really impressive discipline in other areas. They cut their distribution costs and their administrative expenses. But the real hero in getting that loss down was this $214,000 write-back. Basically, they previously thought some customers weren't going to pay up, but now they expect to get that money after all. That accounting gain, plus the cost cuts, is what nearly pushed them into the black. Okay, so that explains the profit situation. But, you know, as any good investor knows, profit is just an accounting figure. Cash is what pays the bills. So let's pivot and take a look at the cash flow statement. How's the actual cash situation looking, Ben?
Well, Alex, this chart right here might just be the most impressive thing in the entire report. It's a night and day difference. Last year, their day-to-day operations burned through almost $7 million in cash. This year, they generated over $400,000. That's a huge swing. It tells us the core business is no longer bleeding cash, it's actually bringing it in. That's a super healthy sign.
Okay, so let's recap. We've got booming sales, but squeezed margins. We have tight cost controls and a fantastic turnaround in cash flow. It really sounds like we're just talking about a retail company. But as we hinted at the start, is the gift business really the whole story here? Not even close. And this is where the story takes a massive turn. When you look at what the company actually owns, its assets, the picture changes completely. A whopping 65% of all their assets are tied up in something called development properties. Now, compare that to inventories, the actual gift baskets and products, which is just 5%. 65%! So what exactly are these development properties?
It's essentially land and all the costs that have gone into real estate projects that they're currently developing. We're talking about a value of nearly $45 million. So this isn't some small side project. It is the single biggest thing the company owns by a long shot. Noel is basically two companies in one, a gift retailer and a pretty significant property developer.
So how do you fund a $45 million property venture?
Well, the reports tell us exactly how, with debt. The company has taken on over $33 million in bank loans, and the collateral they use to get those loans, you guessed it, those same development properties. So they're leveraging their real estate to fund even more real estate.
Wow, okay. So when you invest in Noel Gifts, you're not just betting on hampers and flowers, you're betting on a leveraged property developer? That completely changes the game. So let's put it all together. From an investor's perspective, how do we balance these two very different sides of the business? Exactly. It's a real tale of two businesses. On the one hand, you've got these great opportunities. The gift business has fantastic sales momentum, they're generating positive cash flow from operations, and of course, there's the massive potential upside from that $45 million property portfolio.
But on the flip side, you got some pretty big risks. The gift business, as we saw, has margin pressure, and the property side brings that huge $33.5 million debt load. That makes the whole company really sensitive to interest rate hikes and the general health of the property market.
Right. So if we were to boil it all down, here are the 4 key takeaways. First, and most importantly, know that you're buying 2 businesses in one. Second, keep a close eye on those margins in the gift business. Revenue growth is great, but it needs to turn into profit. Third, that positive cash flow from operations is a huge green flag. And finally, you have to understand that Noel's future is a big bet on real estate. That's where most of the value and most of the risk really lies. A fascinating and complex picture for any investor, for sure. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.